Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in. Today, we are thrilled to have Sunil Pai, GP of Angel Collective Opportunity Fund. Angel Collective is a collaborative opportunity fund. That means it's a pool of capital investing in a select group of emerging managers' top companies. Sunil will explain in more detail. Thank you. He is ex-Deloitte, ex-DFJ, ex-AngelList, where he led the emerging managers business line. They handle all the SPVs, the funds, the rolling funds, etc. And we are looking forward to hearing today about this alternative to SPVs, as well as Sunil's unique take on how to navigate the explosion of emerging managers. Hello.
Hey, great to be here.
Would you mind giving us a little background on your career in venture?
Sure. So even before venture, so I grew up in Oklahoma, came out to the Bay Area for school. That kind of got me in tech. Originally wanted to do law and then hard pivoted. But, I wasn't sure what I wanted to do when I graduated from school. And so I went into management consulting and I was pretty happy with that. But, a lot of my friends were working at startups. They were going through YC. They were like raising capital. And I was like wearing a suit flying across the country. And so I was like, I like what I do, but maybe there's something else. Maybe there's something more exciting. So my journey into venture capital actually happened by, me trying to go work at a startup. I would go to demo days and pitch competitions when I was still in town and try to meet a startup that I would want to go work at. And so I'd ask questions. And when I was in the audience at one of those demo days, a partner at DFJ was like, "Oh, I like the way you're asking questions. Like, this is really interesting." So that was my first point of contact with that firm. And then my roommate at the time was a YC founder who had been funded by DFJ. And so he was he put in a good word. He's like, "My roommate would probably be a good investor. You guys should chat with him." So then they reached out, the recruiter reached out, and we started that conversation and ultimately landed a role at DFJ. When I was pretty young, so I was 23 years old. At that time, I knew very little about venture capital, didn't know what MRR was, didn't know what ARR was, didn't know how to evaluate companies, but I was very excited about it. And they were gracious enough to take a chance on me. And so that's kind of how I got my start there.
So, Sunil, that resonates with me so much. You grew up in Oklahoma. I grew up in Arkansas.
Oh, wow.
I don't know about you, but I was taught that at the time, smart people do one of two jobs. They're an attorney or they're a doctor. So that's all I thought. Yeah. So that really resonates with me. That's really cool. You mentioned you got introduced to DFJ. What were the lessons learned of that very brand name shop?
Mm-hmm. Yeah, DFJ. So they're now called Thresholds. They've done a rebrand, but legendary kind of firm for many decades, early into Skype and Hotmail back in the day, and have still just produced incredible returns into more recent companies that we've all heard of. But some of the team that I was working with, Steve Jurvetson, early in SpaceX, Tesla, Planet Labs, Nirvana Systems, Josh, who's, kind of traditionally a SaaS investor, was early in Box, Rippling, Twilio, Front, launched Darkly. And, Emily is more of a generalist, but Redfin, Shift, and BetterUp. And Alexa, you know that company well. So yeah, got to learn the ropes from some of these really important and great investors. And as a junior person, I think that was really helpful. So I came from a very armchair background, studied political science and philosophy, and then management consulting, and then venture capital. So I didn't have a lot of real work experience. I didn't have operating experience. But what DFJ provided was you get to be in the room with these investors and you understand how they ask questions, how they assess markets, how they think about where they want to bend and break on valuations. And it's so interesting to be in the partner meeting after the entrepreneur leaves. And then you hear, what do we really think about this market? Is it going to stall out? She had a big exit before. Are they still motivated to do the next company? You get to hear those questions and you learn from the best. And I think that's one of the best parts of, being at an institutional firm, is having those gloves off conversations and being able to be an apprentice and learn from all of their experience, because I had none.
And then what came next?
Yeah. So after about 4 years at DFJ, I knew I liked investing, but I felt I had a chip on my shoulder because it's very obvious. I was like, my career had been in evaluating outputs. You're looking at growth rates, you're looking at metrics, you're like, as a consultant, you're from the outside, you're evaluating, high level strategy decisions. But I had not been operationally involved in a company. I'd never been responsible for a metric, had like a real deadline I needed to attest to, never had a board or anything like that. And so I wanted to do something in an operating role, but I knew I loved investing. So it was like a really difficult decision to leave. And AngelList was such a perfect fit because it's a startup within the context of investing. I had known the team, had known several of the members there before I joined, and I was incredibly impressed by them. And as I got to know the company, this was in 2017, there was a really cool vision that resonated with me, which is, hey, these venture funds are getting bigger and bigger. They're, now $1 billion funds. They're going to be $3 billion funds. And if you just kind of draw that out, what does it mean? It means that if you're a partner at a $3 billion fund, it makes no sense for you to sit across the table from an entrepreneur raising $1.5 million pre-seed round. It's not worth your time. And so what the vision for AngelList was, and what I was really sold on, is we're going to be the infrastructure and tools to enable these angels, kind of turning super angels, to be emerging managers. And then they'll take over pre-seed, they'll take over seed investing, and maybe even Series A, which was non-obvious at the time, but that was kind of the vision. And that's what got me really excited about the team back in 2017.
Were there any insights there that led to what you're doing now with the collective?
Yeah, totally. So when I joined AngelList, it was like a single product. It was syndicates. You could do SPVs, and a lot of people had the impression that it was crowdfunding, like, oh, it's someone investing $1,000 into a startup, and maybe they're in the Midwest and aren't not that sophisticated. But the vision was always to kind of build out more products and move up market, almost like classic Clay Christensen disruptive innovation theory. Start like a toy and then you move up. And so what we would see, it was started with syndicates. And then as we brought emerging managers on the platform, I saw this problem repeatedly, which is there's a category of people called like solo GPs. Mm-hmm. They start their own fund and it's like a team of one. They're the ones sourcing deals, evaluating deals, supporting the companies. And you get a lot of flexibility. You build your own brand. There's not bureaucracy there. You can move really quickly. But generally, these solo GP funds are like, let's say, sub $30 million often. And some of them are very, very talented. They know their niche. They know how to pick. They know how to support companies. They have great reputations with founders. But they all run into this problem of what happens after I pick a winner? As the company grows up and raises a Series A, B, and beyond, they end up losing their ownership. They get crammed down by the larger institutional venture funds because they don't have enough reserves to invest in their pro rata. And so it's like one of two things happens. Either they just give up their pro rata and it's not part of their strategy, or they scramble and they try to put together an SPV. And that is very hard to do for a couple of reasons. First, it's their LP base is primarily like other operators, maybe some family offices. They're not primed to move. Maybe it's not their strategy to do co-investments. And it's often hard to get them to move really quickly. And if you were a seed investor in a great company and a tier one venture firm is leading the Series A, you don't have 3 weeks to scramble around and put together 500K. Someone else wants it and they have a dedicated fund and they'll take it immediately. That's often a better decision for the founder. Yeah. So we saw that there's this category of managers that are really interesting. The data is showing that they're quite talented, and they have this problem of not being able to double down on their best companies. So that's it from a GP perspective. And from an LP perspective, we're seeing this explosion of managers, hundreds of managers, getting into business. And how does an LP, whose venture allocation is kind of a smaller part of their overall strategy, how do they evaluate this manager who is at Stripe for a few years versus this manager who is working at Slack? Like, how do you pick if you're not really in the field? And so that was kind of the genesis for the fund we started.
Wow. Where did, just before we kind of dig into the collective, where do you think your initial thesis that you were building while still at AngelList, where do you think you were right? and where do you think things have kind of turned out differently?
Yeah, when we started the fund, we've been noticing this for a while, but we started the fund in 2021. This is a very different market than it is today.
Yeah.
And so, even the name Opportunity Fund, we thought we were going to be doing much later stage investing. We thought we were going to do like mostly Series C and beyond into these companies. And what we realized is, for a couple of reasons, we want to move earlier into the market. And so where we often invest now is, 90% of what we're doing is like Series A adjacent. Maybe it's like right before the Series A, maybe it's right after. And that's where we want to play. And the reason for that is, emerging managers have a really good instinct around when companies are starting to work. It's a very different kind of decision-making calculus to be evaluating price and valuation for a growth stage company. And so over time, we've kind of moved down market and increased our ownership, which was, it's, I think, a good realization, but something that took a little bit of time for us to kind of refocus on.
Yeah. Yeah, you have a lot less insight too. It doesn't necessarily align with your skill set or when you are the number one phone call for that founder.
Now we're going to take a quick break to speak with our sponsor.
Next up, we have our industry expert and sponsor, Brian Huber, fund partner at Gunderson Dettmer. PitchBook has named Gunderson the #1 law firm globally for investors 10 years in a row. Our guest Brian's practice focuses specifically on structuring, forming, and operating VC funds. I have used Gunderson in my own fund formation, and I can highly recommend them. Thank you, Brian, so much for your advice and expertise. And in addition to helping on the fundraising side, you obviously also help your managers operating. Is there any issue that's been top of mind for your clients these days on the operating side?
I would say, yeah. So there's two things, and they're semi-influenced. Well, one of them is definitely influenced by regulation because it is regulation happening this year. It just went into effect January 1st. Is the Corporate Transparency Act, which is impacting not only funds but pretty much any business. And it's a requirement unless you're exempt to report certain information about your beneficial owners. Again, I think this is going to be something that we're going to see more and more of in the U.S. It's something that's already seen in other countries and other jurisdictions, and so it's not necessarily a surprise, but it's a very broad scope law. And so one of the things we're dealing with, a lot of venture funds are exempt. A lot of venture fund entities are exempt, but there are some entities that don't technically meet the requirement of exemption. So there might be, you might need to decide whether you're going to report, which way you're going to report beneficial ownership. It's still very new, and we're we don't have a lot of info right now on enforcement and who they're going to go after and what it's going to look like. So that's something that is just, you try to be as upfront and advanced about getting it done as you can be. And it's one of those things that again, that's more for the lawyers to deal with, but the clients are dealing with it because it is, we're telling other people who your owners are.
No, that's why you've got lawyers.
Exactly.
Thank you for dealing with it.
Yeah. And then I think the other one is, for the past few years, the states have California is one of them, has an anti-competition regulation that by and large restricts or prohibits the ability to use non-competes. Recently, there's been a federal ban on non-competes. And so I think you mix that with an environment where people are reevaluating whether they want to stay with a firm. One issue I think that comes from that is retention, keeping talent, and what are other methods if we can't use a non-compete to inspire folks to stay with us. And so there's been a number of discussions this year on whether how we approach vesting of interest. Mm-hmm. Do we expand it to be longer? Is it sort of, you have to, you only vest a certain percentage, not 100% until you've liquidated, that sort of thing. And again, I think it'll be interesting to see where that goes, because I also think that while we had non-competes in a lot of these management company and general partner agreements, I didn't see a lot of people actually enforcing them. And I think that's in part because the expectation is that if you leave a firm, you're probably going to go compete. And, while there's certainly things you want to restrict them from sharing, it just hasn't been in the nature of venture to to say you're on timeout for a year, right? Mm-hmm. And so maybe it won't be a big change, but it's definitely something that folks are thinking about.
Yeah, no, that's fascinating, because certainly whether it's processes or relationships, there's a lot of things that are personal in the VC role as opposed to owned by the company. You work with a lot of these leading venture capital firms as well as first-time managers. Is there anything that in operating with the larger, more established firms, you see them do really well that our emerging managers would benefit to hear about?
Yeah, so I think on this one, and it's kind of an obvious answer, but there's also some nuance to why I think it works. The obvious answer is that they have much more well-functioning back offices, and that's because they have more money to spend on that. But I think the nuance here is that they've gotten to a place where they've picked and stayed with service providers that they vibe with, that they think work well with their approach to things. And that's, legal advice, accounting, audit, fund administration. I think it's really important to try to partner with somebody that sees your vision and sort of goes about it in a way that complements what you're doing. Mm-hmm. I think with newer managers, there's this, everything's expensive. I don't want to, I kind of want to control a lot of what I'm doing. There's, I want to make sure that my hand is in everything and that I've signed off on everything. And I totally get that. I think where the freeing moment and the moment where you become efficient is realizing that your talent is to invest and seek the companies. Let people that do this, this for a living, handle the stuff in the background and support you in your way. And I think to do that, it's a matter of finding people that work with you. Don't necessarily go for the lowest cost provider. Because what you'll get is what you pay, or what you pay for is what you get. And I think, what's really good about the current state of things is that there are a lot of options where a lot of it is becoming automated and the use of AI to help with mundane functions that would otherwise be done by somebody who's a fee bearing or fee accruing a person, that cuts out a lot of that work. And I think that'll be super helpful in getting to I've hired this person to provide, advice on certain things. And so I think that'll help emerging managers get to a place of very good efficiency a lot quicker than maybe they could in the past.
Brian, it's been a pleasure. To get in touch with Brian or any of the other lawyers at Gunderson Dettmer, please visit gunder.com. That's GUNDER.com. And now back to our LP interview. Let's do a 411 on what is the Angel Collective Opportunity Fund.
Yeah, sure. So we call it ACOF. It stands for Angel Collective Opportunity Fund. And the idea is, there are these really talented emerging managers who generally don't have the capital to double down on their best companies. And so what we do is kind of form a collaborative opportunity fund. So my co-founder, Nick, and I were kind of in the field, constantly talking to these emerging managers, figuring out, who we think is really great. And often if you're, a manager with sub 30 million or even sub 50 million, you don't have capital for reserves. And so there is a problem that we can solve for those GPs. And what we do is we partner with 4 of them every year, and they continue to run their fund. They continue to invest in pre-seed and seed opportunities from their fund, but we become the investment vehicle right after that. And so when they've invested in a breakout company at the seed level and they've been tracking it really closely, and now the company's hitting an inflection point, maybe a brand name VC is leading the round and they have their pro rata, we can enable them to move quickly into the company and double down, protect their ownership. And it happens through our fund. The fund is making a direct investment into the company, and then we share the carry back with the manager. So importantly, it's not a fund of funds. We're investing direct into companies, but it's sourced by these emerging managers that we think are really special.
Is there a commitment when you said you bring on, I would love to get into how you select them, but before, once you've selected them, is there a commitment on how many potential, or is it just from that time period?
Yeah, there's 2 parts, which is We only work with 4 managers every calendar year. And we found that to be the right number because we share the economics very generously. And, we want managers to be incentivized to do their best deals in the companies. If we brought on 10 managers and let's just say we did the math and everybody's just getting 2% carry on every deal, I don't know if we would be able to incentivize the best managers to do this. Maybe they'd go out and do SPVs instead, or maybe they'd raise a larger fund. But if we can give them strong economics, then we can make a really compelling case for them to do their best companies. So we find these managers and we ask them to make a 1-year commitment to us. Because, if you wanted to go out and raise a $100 million fund yourself, we're not going to stop you. And so we say, let's try this out for 1 year. If this works out and we're solving a problem for you and you like working with us, we can continue for another year, but we're not going to try to handcuff you into being into the fund. So let's try this as a 1-year experiment. And it's worked out really well. So that 1-year commitment is the minimum that we ask for. And we often kind of rework with managers over the years as well.
How do you decide on which managers you're going to work with?
What we're looking for is early stage, and these are guidelines. We've broken the rules sometimes. So what we generally look for is, first, we want to see a body of work, generally that they've invested in about 50 companies. And it might have been they've worked at a fund before, might have been through an angel track record, or maybe they're on fund 2 right now. But there's enough of a corpus that we can see this isn't one of their first 5 deals. We know we can assess their judgment, their taste. We can do references on them with founders. We know how they work with people. Generally, under $30 million funds. So they don't really have a reserve strategy and we can solve the problem for them. We see high performance. So 30% plus IRR as a floor. And then what we like is folks who are pretty specialized in what they do. They've got a swim lane of what they're looking at. And so, this year we've got one manager who works on data tools and infrastructure. It's just what he does. Or we were talking about Tommy earlier, he's focused on climate tech or national defense. And we like that because it's, there's manager market fit. We can see they've been doing this. They've got a reputation in this space. This is their swim lane. They've built a brand around it. And we really like that. Obviously, generalist investors work, and we've worked with some of them in the past as well. But we think that having a specific swim lane makes it really clear when you're adding managers together that people aren't stepping on each other's toes in deals and they're focusing on what their superpower is essentially.
And what's the pitch to the founders? Because your ultimate decision maker is the founder raising the capital.
Yeah. So our fund doesn't want to cause friction in the investment process for a founder. That would completely break the model. And so essentially, how an investment works is it's an emerging manager who's often taken the first bet on the founder. They had first invested the pre-seed or seed. They're working with the founder very closely and, they're texting them, they're helping them raise the round, and they've got their pro rata. They talk to the founder and they say, hey, I'm part of an opportunity fund. I'd love to do my pro rata from ACUF. Here's how it works. I'm still going to be the point of contact to you. We still continue this relationship, but the capital is coming from a later stage vehicle that I work with. And I want you to meet these folks as well. So we generally are in contact with the founders. We don't want to stand in the way, but it's essentially just a different name on the cap table. But the founder is still interfacing with the manager that kind of took the bet on them. They're the face of the check.
And do you have an average check size so they know what they're representing?
Yeah. So, we're structured as a rolling fund. And so we're able to take capital in at any point. And each manager, there's 4 managers, so they each have access to about a quarter of the fund's capital. And what that means is generally on the smaller end, we're writing checks of about $250K and then a little bit upwards of $1 million.
The other stakeholder is the LPs you bring in. So talk to me about, being a rolling fund. What's the kind of ideal LP for you?
Yeah, so the rolling fund structure, just to break it down, is essentially it's an open-ended fund where LPs kind of make a subscription on a quarterly basis. So, typically the process in a traditional fund is I'm an LP, I, typically invest $2 million. So I, make that commitment, and then there's multiple capital calls. But it's $2 million that is invested over 2 years or something like that. What a rolling fund does is enables LPs to invest on a quarterly basis. So you can do the same thing. You can say, I'm going to invest $2 million over 8 quarters. You just break that down into a quarterly subscription, but it enables us as managers to take in capital at any point. There's no final close to our fund. If we meet an LP today, they're interested in our model, they can join next quarter. We're open-ended in that sense. So it gives us a lot of flexibility. And in essence, we can take capital in at any point, but there are drawbacks, right? And part of that is it's a new model. It didn't exist, 5 years ago. And so it does require education for LPs. We're telling about this model. We're telling them, we're giving guidance on what a subscription should look like if you want portfolio diversity across different managers and different classes. So there's the time it takes to explain that is important. And, I think that our story resonates really well with family offices as an LP base. They're the ones that are kind of interested in early stage emerging managers. They've met a lot of them. It's very hard to make that decision on how to pick because there's hundreds. They felt this problem and they're open to like novel structures like this. And this enables them to join for a year, join for 1 year, and then decide if you want to, come back for the next year. We've had conversations, we have a fund of funds invested in us as an LP, but mostly it's been family offices. And I think the model allows them flexibility. It's something that they get. We found that larger institutions and endowments, it's a little bit too new for them. And so we found our LP base to be strictly family offices.
We've had a few fund of funds on to explain sort of the benefits of, okay, we're meeting all of these emerging managers so you don't have to, and you're getting diversification. What's the data around opportunity funds? You're now, sounds like, pretty squarely in the like Series A, B rounds. What should LPs know about the opportunity at this sort of echelon?
Yeah, I think opportunity funds, it's generally meant context wise, I think a lot of the institutional funds do it almost like a growth fund. It's like where they cherry pick their best companies, but they are investing at the later stages. So what we're doing is a little bit different from that just because we're coming in early. But I think the PitchBook data is showing that some of the highest performing funds of all time have been opportunity funds. If you look, I think it's USV's 2018 vintage or something like that. It performs terrifically if you can get that model to work where you're seeing the companies early, you've got the relationship, and you've got this separate vehicle that you can double down. Then across the life cycle, that's a winning strategy. I think where we're a little bit different from that is just that we're coming in early. We think the best returns are still early. We're not the best late stage pickers, but we can identify when a company is going from inception and it's having that inflection point where there's strong pull of product market fit, valuations are still low. That's where we kind of consider the opportunity to be the greatest.
Is there any expectation on kind of the rate of deployment?
So the rolling fund model, just very tactically, we've got an amount of capital that we can invest this quarter. If we don't invest it, it just rolls over to the next quarter. Okay. And new capital comes in. So there's no gun to your head, no pressure to deploy. It just rolls over by default into the next quarter. We generally want each of our 4 managers to be doing maybe 4 to 5 deals a year into their best companies. And so we're investing 20 to 25, a million, maybe a little bit, 20 to 25 companies per year. And that's kind of where we see the portfolio construction come in.
Okay. Does this end up being a full-time job?
Yeah, this is what I do full-time. I'm still involved in, a couple of companies. I'm an advisor, but this is full-time and hands-on in the sense that my co-founder and I, we're, putting together the team of managers. We're out raising the capital, kind of constantly raising because it's an open-ended fund. And we also, help make the decisions on the fund. So the managers are the ones sourcing. They provide their diligence. I've known this company for 24 months. Here's why I'm a believer in them. Here's why I think the valuation makes sense. Here's the upside. But ultimately, my co-founder, Nick, and I are the governance layer on the fund. And so this is where we're kind of full-time.
So now you've had a very interesting perspective from being inside a firm to being at AngelList. And at AngelList, your firm was kind of responsible for the boom of this new crop of emerging managers. And I will say emerging founders who are part of the fund administration stack.
Yeah.
But on the emerging managers, who do you think should be starting a fund now and who shouldn't?
Yeah. It's funny. I sometimes joke that AngelList is the arms dealer for emerging managers. It provides the infrastructure for everyone. And I think we saw a lot of interesting things happen in the 2021 timeline, right? Like I think there was a period where it almost became like a meme, like if you have a big Twitter following, when are you going to raise a rolling fund? A lot of people just thought because they have distribution, they could be great investors. And that's generally not the case. There are some cases in which it works out, but I think where I like to see, emerging managers and their background is like the emerging manager market fit. Are you investing in something where you have a lot of experience? The things I personally don't like to see is maybe a person who's had a career in consumer marketing and then they're just excited about deep tech and they want to raise a deep tech fund and invest in national defense. That doesn't translate, right? I don't think it does. And so I think where people should really think about, do I want to start a fund, is first, am I unique in the market? Does my experience translate into better access, better judgment? Do I have taste in companies that are doing well? Second, I think you need to the extent that you can, learn on your own dime. There's folks out there that just because they have a megaphone and they can raise a 10 or $20 million fund, it doesn't mean you should start that way. You should start, if you can, as an angel. And even if you don't have a lot of personal capital to invest, it kind of tests your skills. Can you convince a great founder to take a $2,000 check or a $5,000 check and let you be on the cap table? So you learn by yourself. And then I think you take other capital when you've proven out the track record. And I think one thing that I really like to see is I love managers that have a lot of skin in the game, who are betting on themselves. Obviously, a fund is a great source of leverage, but do you do more than the average GP commit? Or if you're not able to, are you reinvesting your management fees back into the fund? Are you aligned with your LPs? And so those are the kind of subtle things that I think are really important in assessing a manager's motives. And when you're making a bet on them early, you want to be paying attention to these signs. And then it's not just necessarily how loud someone is, how much hype or how much brand they have, but really looking to, can they connect the dots? They have a unique perspective that founders want to listen to, where founders will take their money, where they will work with founders and build a reference network that will create a cycle for them to go to fund 2 and beyond. And I think emerging managers should be really thoughtful about that down the road before choosing to start fund.
You've enabled so many people to become angel investors, and it is sort of tough to make billions if you're investing $1,000 at a time. Best case, you get a 100x, and your $100 is still not enough to do a down payment on a house today. So, do you see sort of an emergence of a new LP class as well? And who should be being LPs into funds or opportunity funds like you're on? Like, is your product something that is well suited for somebody maybe with fewer net assets than somebody who's, in order to do venture well, going to have to invest in 5 emerging managers a year for 10 years?
Yeah, I think so. So on the emerging manager side, I think yes, it's hard certainly to invest, $1,000, $2,000 into companies, and then the returns are generally going to be capped. There's alternative models too. Instead of starting a fund, someone could go be a scout. Someone could be a part of a program there, or partner with other folks and do a fund together, maybe not as a solo GP. But I think it's important to show proof points before you scale up fund size was my point on that side. But on the LP part, I think it's really interesting. I think LPs are faced, and they're kind of inundated with all of these small fund managers, and it's really hard to evaluate. And in venture, you want to also be diversified. You don't want to just invest in a couple of funds. You need to have broader access to the asset class. You want to receive diversification across vintages. And I think our model kind of solves for some of those challenges, as well as it's actually very challenging to be an LP in an institutional fund. If you're a smaller family office, how do you be an LP in a tier one brand? They have wait lists, they have investment minimums. There's a lot of competition to be an LP in one of those multi-stage funds. And so what we provide our LPs is diversification across top managers and across vintages, where we're very open with our LPs. We work collaboratively. We share a lot of updates. We share our investment memos, and so they can see like, okay, I understand why these 4 managers were chosen. I can see their track record. I know why they're interesting, and I'm going to take a bet because they're still unproven. They're not household names yet, but this will give me diversification, and I'll be able to learn. And the returns are potentially really high if they're successful in what they're doing because they're investing so early. So on the LP side, I think we hit the mark on family offices because it solves like a real core problem for them.
You were a junior VC. So what advice do you have for your younger self? If, someone had aspirations of starting their own fund, what should they be doing?
I think the single best thing that I did in my venture time at DFJ was I just had like an Excel spreadsheet open every Monday partner meeting, and I just kept myself completely accountable. I was not a decision maker. I was junior. I was at the bottom of the totem pole. I was doing the grunt work. Great, happy to do it. I would provide my opinion, but I couldn't lead a deal. And so when I was working with the partners, I would write down for myself, here's the company, here's what it does. If I was a decision maker, would I do this deal? And I just kept track of that across multiple partner meetings and over time. And so now I can see like, it's not an official track record, but it allows me to like assess my own judgment and where was I wrong and where was I right? I think that's really important because there's this, tempting allure of revisionist history where when a company becomes successful, now everyone, we all saw it, the whole partnership wanted to do this deal, but often like the best companies are very controversial. There's a lot of loud no's in the room. And so it's easy to sometimes like generously forget what that conversation was. And so I think if you're junior and you're not yet in the position to be leading deals yourself as a general partner, just keeping track of that and monitoring your own judgment over time. And you'll be wrong sometimes, you'll be right sometimes, but just being open and accountable to that is important.
And part of being trained as a VC is we're supposed to see blue ocean opportunities. And curious, this is such a unique model that you've pulled together. Are there any others that you are intrigued by when you look sort of around at what your colleagues who are getting creative are doing, where you think, oh, that's actually different and actually makes a lot of sense?
Yeah, it's a good question. I think some people I think there's a lot of trends of emerging managers kind of going from solo GPs to combining brands, which is interesting, where a couple of years ago, the capital markets were different. It was maybe easier to raise a fund. Now it's a little bit harder. Maybe they want a support system with another manager, or maybe they want to combine forces. I think that's going to be happening more and more, where there's kind of like mergers between emerging managers, which is an interesting trend that we're keeping track of. And I also think what I really like to see is, fund managers who don't necessarily want to be franchise names. Not everybody's goal is to have $1 billion under AUM. And I really want to be on the lookout for these managers. And there's not a whole lot of them, but they want to stay small. They know their model. They know the cottage like model of where they're really good. And they don't want to expand quickly into being a growth stage investor and having 7 other partners and, all the scale problems that come with deploying large amounts of capital. They know what they do and they kind of stick to that knitting. That's something that I'm keeping an eye on.
That's fascinating because I just earlier today spoke with somebody. They were asking me what I think is going to happen in the industry. And I was like, I'm meeting a lot of great solo GPs that I know want to partner with someone and they just didn't want to rush it. I was like, so I think they're going to be mergers, but wow, that's crazy. So Sunil, just as we kind of closing thoughts, want to know, is there anything else that you would love to cover that maybe we didn't mention? Any ideas, predictions?
Or the other thing is just I want to give a lot of credit to my co-founder Nick, because I'm the one representing our firm here. But yeah, my background has been in kind of institutional investing and then working at AngelList. But he comes from the founder background, and so that push and pull of the different kind of styles of investing has been really helpful to us. So yeah, shout out to Nick.
Good stuff.
No, it's been so cool to hear how you all have come to this model. Thanks, Sunil. Thanks for being on the show.
Awesome. Thank you.
Thanks, Sunil.
Thank you very much.
See you later, Allocator.
After Portfolio Tile, investing with a smile.